Welcome to Breaking News to Trading Moves.
Today we're looking at a deal that really caught my attention.
Yeah, it's SoftBank's plan to acquire the digital infrastructure owner DigitalBridge.
And this isn't just, a simple corporate buyout. This is a major signal.
A signal about what, exactly?
About where very serious strategic capital is flowing right now. And it's flowing directly into the web of digital infrastructure.
That makes sense. I mean, SoftBank is known for making these big forward-looking bets.
And they just made a very clear one.
So our goal today is to look at the immediate consequences of that. What this $4 billion agreement means for the market, who stands to benefit, and, well, who might be facing some new headwinds.
It's the kind of move that brings a lot of clarity to several different sectors. A must-watch for anyone tracking how AI gets turned from, an idea into actual physical hardware.
Okay, so let's start with the hard numbers, the terms of the deal.
Right.
SoftBank is acquiring DigitalBridge, ticker DBRG, for about $4 billion.
And the price per share really tells a story here. They're paying $16.
$16, and that's a premium, right?
It is. It's about a 15% premium over where the stock was trading before.
That's a powerful indicator. It shows how much value SoftBank sees in these specific assets.
They're willing to pay up.
A 15% premium is definitely not small. It feels like they wanted to secure this portfolio, and fast.
And another detail that stood out to me was the management structure.
You're talking about the CEO, Marc Ganzi.
Yeah, he's staying on to run the whole thing as a separately managed platform.
Which is key. It shows this isn't an asset strip. They're not just buying the buildings.
No, not at all. They're buying the operational expertise, the proven ability to execute in a very specialized field. The whole rationale for SoftBank is to lean harder into what they're calling AI infrastructure.
AI infrastructure, we hear that term all the time. What does it actually mean in physical terms? What does DigitalBridge provide that's so essential?
It means you need specialized physical stuff. I mean, yes, massive data centers, of course.
But it's more than that.
It's so much more. It's the critical power generation. It's the advanced cooling systems, liquid cooling even. And it's the entire construction ecosystem that can actually deliver that AI compute demand at scale.
So they're buying the foundation, the literal foundation that AI runs on.
That's it, exactly.
So if a huge player like SoftBank pays a premium $16 a share to get into this space, what does that do to everyone else already playing in the data center world?
Well, it basically sets a new price floor.
Okay.
M&A premiums like this, they tend to reset how the market values all the other comparable platforms. When a buyer with deep pockets makes a move like this, it supports higher valuations across the whole sector.
It's like a confirmation for every investor out there.
A confirmation that digital infrastructure tied to AI isn't just a good idea, it's a scarce and necessary commodity.
That makes a lot of sense. The market starts thinking, if SoftBank paid $16, maybe our asset is worth 14 or 15.
Exactly.
But let's talk about what's driving this demand. This spending isn't random. It's following a pretty clear supply chain, right?
It's a classic demand outpacing supply situation, specifically computational demand.
The AI compute demand.
Right. The basic equation is this. The need for AI compute creates an absolute requirement for way more data center capacity.
But building that capacity isn't just about finding a plot of land.
Not at all. It generates a huge wave of orders for very specific components. We're talking advanced electrical gear, massive cooling systems, and the specialized contractors who know how to put it all together.
It sounds like a gold rush, but any rapid growth like this always hits bottlenecks. What's the main thing holding back this entire AI build-out?
The primary constraint is energy.
Power.
Power availability. These hyperscale data centers need guaranteed enormous amounts of electricity. And securing that power is becoming incredibly hard in a lot of the places you'd want to build.
You mean near cities or fiber routes?
Exactly. We're bumping up against the limits of the existing electrical grid.
So even if you find the land, if you can't get the megawatts, the project is dead in the water.
Dead in the water. And the second constraint, which is related, is the scarcity of suitable sites.
Right.
The land needs the right zoning. It has to have fiber connectivity. And crucially, it needs immediate access to high voltage power lines. That combination is getting very rare and very contested.
So with these two inputs, power and sites being so scarce, what does that do to the overall cost of building out AI infrastructure?
It just drives everything up.
For everyone.
For everyone. These scarce cities push up the capital expenditure, the CapEx, for the biggest consumers. So the companies spending the most on this, the ones who need to deploy globally and fast, are now competing for these finite, high-cost resources.
Every megawatt, every square foot of land, it just gets more expensive.
Exponentially more expensive.
Okay, let's switch gears and talk about the clear beneficiaries here. This SoftBank move is a catalyst. We can probably group the winners into, say, 3 different areas.
I think it's a good way to look at it.
Let's start with the property owners themselves, the landlords.
Category 1, digital infrastructure owners and data center landlords. As we said, the premium SoftBank paid for DBRG really supports higher M&A multiples for the whole sector.
It shows real conviction in the long-term value of these physical assets.
It does.
So who are the main public companies that feel that lift in valuation?
Well, besides DigitalBridge itself, you look at the other big landlords, that would be Digital Realty, DLR, and Equinix, EQIX.
And a deal like this just validates their entire business model.
It does. It confirms that their growth is tied directly to these huge adoption curves for AI and cloud. They're basically the toll collectors on the digital highway.
Okay, so once the landlords have the property, they need to actually build the data center's engine. That takes us to our second group of winners.
The hardware suppliers.
That's category 2, data center power, cooling, and electrical equipment.
The industrial side of the AI era.
Exactly. All this new construction and expansion, it directly translates into pull-through demand for very specific components. And we're not just talking about simple air conditioners here, are we?
Oh, no. This is complex, high-margin equipment that has to manage incredible amounts of heat and power. We're talking about uninterruptible power supply systems, or UPS.
Right.
Sophisticated power distribution gear, switchgear for high voltage, and especially advanced thermal management like liquid cooling, which you need for these dense AI chips.
And which public companies are set up to capture that demand?
You're looking at the players who are deeply integrated into this ecosystem. So that's Vertiv, VRT, Eaton, ETN, and Hubble, HUBB.
Their order books are probably looking pretty good right now.
Their order books and their capacity utilization rates are directly tied to how fast these data centers are getting built. They provide the specialized plumbing.
And that brings us to the third group, the boots on the ground, the people physically building these things and connecting them to the grid.
Right, the engineering, construction, and grid-related contractors.
This isn't something a normal construction firm can do, is it?
Not really. Developing these huge data center campuses requires highly specialized, high-margin services. You've got the site prep, the complex electrical work, and then the critical part, the transmission, interconnects to the main power grid.
That's the bottleneck you mentioned.
That's a huge bottleneck. And then there are ongoing system upgrades.
So as the pace of these builds picks up, their backlog just grows and grows.
Precisely. More data centers means more demand for their specialized knowledge. Key names here would be companies like Quanta Services, PWR, EMC Air Group, EME, and Mastech, MTZ.
They're the ones who know how to connect a multi-megawatt facility to a regional power grid.
And that's a very valuable skill right now.
Okay, now let's flip this around. Every big capital move creates stress points somewhere else. Let's talk about the groups that are now under more pressure because of this intensified push into AI infrastructure.
Yep, we can identify 3 key groups here too. The first one is probably the most obvious.
Yeah, and that is?
Category 1.
Yeah.
The hyperscalers who are facing escalating capital expenditures.
So, the titans, Microsoft, Amazon, Alphabet. But they're the ones driving the AI demand. Why are they feeling pressure? Can't they just build their own?
They absolutely can, and they do. But the problem is they still have to compete for the same finite resources we talked about.
The power contracts, the perfect sites, the specialized gear.
Exactly. They have to compete for all of that against strategic buyers like SoftBank, who just showed they're willing to pay a big premium. That drives up the cost of every new data center for everyone.
So even with their deep pockets, the scarcity means they're facing this constant upward pressure on their CapEx budgets?
And that can potentially squeeze the margins on their cloud services. That's the real consequence here. They might face higher colocation costs. They're forced into faster, more expensive build cycles. They have to absorb those rising input costs.
So the companies here are Microsoft, MSFT, Amazon, AMZN, and Alphabet, GTO, They have to spend more just to keep up.
Just to stay ahead, yeah.
Okay, the second group you mentioned faces a different kind of risk. You called it a narrative risk.
A relative narrative rotation risk, yeah.
For the telecom tower REITs. Now, why would a data center deal cast a shadow on tower assets? They seem like totally different things.
Well, it's about where investor attention is focused. Investors often chase the main market story, and right now, that story is AI.
I see.
So when the market is laser focused on AI-driven data centers as the top-tier digital asset, the incremental capital, the new money, it tends to shift away from other infrastructure, like cell towers.
So it's not that the towers are doing badly, it's just that the spotlight has moved.
Exactly. It's all relative. Tower companies like American Tower, AMT, Crown Castle, CCI, and SBA Communications, SBAC, they're solid businesses.
But the excitement is elsewhere.
The excitement, the momentum, the valuation comparisons, it all tilts toward compute capacity right now. So that can dilute investor attention and capital flow, making tower stocks look less attractive in comparison.
Got it. Okay, finally, let's talk about competition. When SoftBank comes to the table with a $4 billion check, how does that affect the big financial buyers?
That's category 3. The alternative asset managers who compete for these deals. The SoftBank acquisition is a loud signal that the price of admission just went up.
A lot.
A lot.
Yeah.
When a financially strong, strategic buyer like SoftBank enters the ring, it tends to inflate the prices of all available digital infrastructure assets.
Which means the math gets a lot harder for a traditional investment firm to justify a deal.
Absolutely. Higher acquisition prices suppress your potential future returns. It makes it much harder to underwrite a new deal at a yield level that your clients will find attractive.
So if you're an asset manager that depends on a certain return rate,
This kind of aggressive competition puts real pressure on your ability to deploy capital.
and this would affect some of the biggest firms out there.
It does. We're talking about massive firms like Blackstone, BX, KKR, and Brookfield Asset Management, BAM. They now face stiffer competition for every prime digital asset that hits the market.
So to wrap this all up,
The core dynamic we've seen is this aggressive, premium-driven push for AI infrastructure capacity.
and this trend is clearly rewarding the specialized owners and the equipment suppliers who can deliver that capacity.
While at the same time, it's creating real cost and competitive pressures for the hyperscalers who need that capacity and the asset managers who want to own the underlying assets.
The scarcity of those key inputs, power, and sites is really setting the terms of the game for everyone involved.
It dictates the price and the complexity.
So for you, the listener, a final thought to consider is this. We're seeing costs driven up by scarcity today. But how long can the market sustain these elevated costs before the AI deployment strategies themselves have to change?
That's the real question.
Do we eventually have to move toward more regionalized or maybe decentralized or even just drastically less power-hungry models to get around this power constraint that SoftBank just paid a premium to overcome?
That future adjustment, driven by cost, will really define the next phase of infrastructure innovation.
Please remember that this is not financial advice or a recommendation to buy or sell any security. This discussion is purely the opinion of the author of the source material reviewed.